When we establish our system of life insurance policies for implementing Nelson Nash's infinite banking concept, the life insurance companies offer flexibility in how often we, the policy owners, can pay the premium throughout the policy year. These are called modes, typically annually or monthly, but can be quarterly or semi-annually if that happens to match up with you or your business cash flows. The payment mode can be changed if you find that your needs change as you own the policy through the years. Though, as a mention of caution, if your policy was structured too closely to the modified endowment contract limit, switching away from an annual mode may create a modified endowment contract headache. So why not use monthly mode to pay premium? Nothing wrong with it. By all means, use monthly if you have to in order to implement the infinite banking concept. Just get started. However, your cash flows are more efficient if you set up your policy as an annual payment mode. Here's a table from an illustration which details this table from an illustration details the additional charge commonly assessed for paying other than annual mode. And why do they charge for non-annual? Well, first, it's simple. The sooner an insurance company, receives premium, the sooner it can put it to work and put it to work in the portfolio. And these additional charges are our incentive to move to annual premiums. And you can see the way the math works, it ends up being an APR, an annual percentage rate of, over 9%. So that's kind of the target we're working under. Can we find a way to basically not pay 9% more than we need to? Well, as we accumulate for our annual premiums, where should we store that cash? A checking account at a commercial bank? Well, yeah, it's safe and but the interest rate deposits on the deposits, they don't pay very much, not very attractive. The other big concern is what happens when we see our general checking account balance grow larger. We get the onesies. We may accidentally spend out what we had saved up for our annual premiums. Instead, I suggest that we can use our cash flows into the warehouse or an environment that addresses these human problems that we read about in Becoming Your Own Banker on pages 29 and following. We talk there of Parkinson's law. We conquer Parkinson's law when we have the discipline of setting aside this capital for future use. Not spending it right away, not allowing our onesies to take over. We avoid treating ourselves to unneeded luxuries just because the balance is there. The nice thing about putting it to work within the policy is, it's protected from taxation, income taxation there. And, of course, it honors the golden rule. We maintain the control of the policy. So here's an example of a way we can do that using the policy loan balances to save up for annual premium. And what we've illustrated here, I've shown a little chart where we start off our system of policies and we have an existing policy loan. It could be for anything, maybe a car that you've purchased, investment property, doesn't matter. And we expect to make regular payments back into our policy for a period, in this case, 48 months. And we can see that regular monthly payments will eventually move that balance down to zero, okay? What if we use this policy loan balance to accept our monthly payments that we're setting aside to pay our future annual premium? And we can see here in, say, the third or fourth month, that's what we start with. We start with these regular monthly payments. And then at this point, we make a new policy loan, make our future annual premium payment. This has the effect in this area here of reducing the policy loan balance for those months below what they would have been otherwise had we not been engaging in this strategy. We are saving ourselves policy loan interest. And that is not because it's an avoided cost, we're not paying tax on it. And think of it this way, whatever your policy loan interest rate is, 5%, 6%, 6.5%, that's the rate that you're earning on your money, tax-free, because it's an avoided cost. And we maintain this strategy. We can see here the second year of doing this. Again, we avoid interest on that amount of principal. Interesting thing happens here in the third year where we continue our payments to ourselves into our policy. And look what happens. Eventually we run it down to zero. There's no more policy loan in our system to accept our monthly cash flows for saving up for the premium. So where does this go? Where does that premium end up? Well, that one you could set aside in the checking account for a few months to anticipate, or you can send it in as PUA and increase the permanent death benefit and add to your policy that way. And then in a few months later, when it comes time to make your your loan to make your annual premium payment, you have that capacity to do that. And then you can continue this original policy loan for a few more months. So that, because we do want to be honest with ourselves, we don't want to assume just because the policy loan balance is zero that the amount we actually owe is zero. We do want to be honest bankers. Well, I hope this has been helpful in creating a new idea for you and helping us rethink what we think about in policy loans. I think that this draws us toward a better understanding of using our policy loans, our system of policies, as a reserve tank for our capital that we can add to it and draw it out as we need to. It certainly is the most unique aspect of life insurance policies, the fact that the life insurance company itself guarantees the collateral. So let's take advantage of that. Let's use that where we can and where it makes sense. So give me a call, contact me if you have any other questions. I do appreciate your time, and have a great day.